This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages. Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at how inflation is hammering expectations for the S&P as margin pressures build.
Plus, convenience store M&A is poised to stay busy well into 2023.
And I'm Alex Steele, and I'm coming back. After 15 plus weeks at home dealing with COVID recovery, I am finally here.
Nice. Good to have you
It
back.
is great to be back. A little bit of backstory. I got COVID at the end of January, and I've been dealing with brain fog and fatigue ever since then, and I'm back, but I still am struggling with it, and I'm still recovering with it, and it has been an incredibly difficult, horrible road upwards. So on that point, I wanted to bring in Sam Fazeli. He is a Bloomberg Intelligence Director of Pharma Industry Research, and he's kind of the guy who knew all this before, so we felt like the kind of guy we'd want to talk to when I came back. Sam, welcome.
Thank you very much, Alex, and Paul for having me on. And Alex, I have to say, it's really, really nice to hear your voice again.
Thank you. I really appreciate it. I feel like it took a small village to get me back here. You know, there are obviously a lot of people who got COVID and were seriously ill and have serious ramifications, right? But there are a lot of millions of people like me who have some kind of issue, whether it's, myocarditis or blood clots or memory loss or brain fog or fatigue that are really debilitating, but yet you're not in the hospital and you can still somewhat function. And I just wonder, have we seen any research on that? What do you know about all of this?
Yeah, it's a very, very complex situation, partly because it's only just being looked at in depth in terms of the biology of what's going on, partly because it's difficult to define, because as you rightly say, there's myocarditis, blood clots, brain fog, fatigue, and not everybody has all those symptoms. But we're getting there. There are some pretty good recent research that highlights some of the factors that seem to be predisposing to this, and maybe over time we can try and deal with it.
That's it's interesting, Sam. We talk about, how wonderful the vaccines were for so many people in the world, but this long COVID is an issue that I'm guessing it's not going to be limited. It's going to be fairly broad, and it should be attracting some research. Are any companies kind of looking at it? Because the current therapeutics don't seem to be able to address it.
I really don't think there are therapeutics that are specifically being worked on for this disease. At least not that the companies are talking about. What you first need to do, Paul, is to try and understand the disease and why this carries on. And there was a really good, there are some journals that in the science world that people would I don't know if this is the right phrase to say on radio or not, sell their first child perhaps to get a publication in. And one of them is called Cell. And so there was a very nice paper in Cell that did actually do a pretty deep dive into what are the kind of characteristics of people who end up getting long COVID of some shape or form. So type 2 diabetes obviously was one of them. Mm-hmm. And then the other one was if you get virus in your blood. Because you remember, SARS-CoV-2 is a respiratory virus, right? So if you end up with virus somehow accessing your blood, there seems to be a connection. And then, very interestingly, activation of other viruses like Epstein-Barr virus. Mm-hmm. These are things that we generally tend to carry around with us. And it looks like that you can get reactivation of these for whatever reason, and that's what they're trying to understand, which then go on to give you all these other issues that you're dealing with.
What is the state right now of COVID? I've been in a little bubble, right? When I left, Omicron was up and running, and I come back and I feel like a different version of Omicron is up and running.
Yeah. But if Paul had his way, there'd be no virus anywhere.
That's right.
And I would love to have that. But unfortunately, they've coexisted with humans, bacteria and viruses and fungi and all kinds of weird and wonderful stuff forever. And not just humans, with animals. So we're going to have to deal with these as time goes on. And luckily, we've managed to deal with them a lot, very well. Where we are today is that we're seeing these new sub-variants of Omicron. Some people think that they should be called variants of concern of their own, given a name of their own. But in reality, they are subvariants, and actually Omicron is all these variants are all variations of the theme of the SARS-CoV-2 virus. So today we have in New York BA2 spot 1, 2, spot 2, or is it spot 1? I can't remember now. And that's basically then spreading everywhere else. Then you got BA4 and 5. And we wrote about this a few weeks ago, saying that these have got characteristics that may give them an opportunity over what we already had with Omicron. So that's what's exactly happening. They're spreading. And people who had the original Omicron seem to have a slightly more susceptibility to catching these subvariants, because then there's yet other mutations.
Sam, because of my age, I was able to get the second booster. What are your thoughts about that?
Yeah, I mean, look, there's my view, and then there's a survey we did, as you know. My view is that you probably have the best protection that you could have had after the third shot. And then what you get with these further shots is you get a little boost maybe a large boost in antibodies that gives you protection for a little while, and then that wanes or contracts, and then you're exposed again. Whereas your deep immunity, your T cells, your memory B cells, etc., are all lined up to defend you against severe disease in most cases, right? Again, not black and white.
Thank you all for letting me talk my book, and it was really good to talk to you, Sam. Also, great to get your perspective. Sam Fazeli, Bloomberg Intelligence analyst.
Coming up on the program, how inflation pressures are impacting the S&P 500.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
What a year it has been in the financial markets. There's nowhere to hide, folks. You can't hide in fixed income. Equities are, down near bear market area here. It's been very, very tough. And this past week has put another, it's been another volatile week in the past week. We had a lot of retailers report numbers, and the margin concern became an issue with all this inflation out there, which is a topic that we heard from our next guest often. Gina Martin-Adams, she's Bloomberg Intelligence equity analyst. Gina, thanks so much for joining us here. We saw the retailers report this past week. A lot of concerns that the inflation-induced pressures are really pressuring margins. And that's a topic you've called out for a long time. Talk to us about what you saw in those retailers' earnings.
Yeah, it wasn't pretty, to say the least, Paul. It really amplifies the trend that's been in place in the market for several quarters now of just broadening margin pressure, even more so on retail than most other spaces, which has really, frankly, been the case for much of the last few quarters. The consumer stocks in particular have been the weak links in the S&P 500, but retail margins were even weaker than anticipated for the first quarter, and certainly disturbingly to the market, anticipated margin weakness is going to continue all the way through the end of the year. Analysts took down their forecast for operating margins in the retail space for second, third, and fourth quarter of 2022.
So, Gina, that's the margin side, but so far we haven't seen any top-line problems like demand destruction, which I feel like could be coming because the Fed kind of needs that to happen for inflation to get tamped down. Have we learned anything on that front?
We saw a little bit of mix shift, maybe, though I wouldn't go so far as to characterize it as true demand destruction. What you should see at this point in the cycle is some deceleration in goods sales and some acceleration in services sales, or a little bit of a swap, if you will, in the dominance of those groups. And that's affiliated with interest rates rising. So we should see consumers in general, and maybe we see this more amplified this cycle than ever before because of the unique characteristics of the pandemic, but we should see consumers start to spend more on services, going out to restaurants, going to hotels, flying around the country and around the world and the like, as the pandemic concerns ease, should they ease. We should also see, as interest rates rise, consumers spend less naturally on durable goods, autos, and homes. So we should expect that at this stage of the cycle. We're not seeing a tremendous amount of evidence of a mix shift, but I think we are starting to see that mix shift occur. Now, does that result in slow overall GDP growth? That is certainly the question on everyone's minds. So far, the consumer generally seems to be hanging in there. It's just they're not spending as much on goods at retail, and to the degree that they are spending, the retailers are spending a lot more to get those products on the shelf.
All right, so we are in the midst of this pretty significant sell-off, Gina, the S&P off at or near 20%-ish range. And I know you and your team do a lot of valuation work. Is there a valuation floor call to be made anywhere in this market?
Yeah, it's a great question, Paul. It really depends on where interest rates go. For the most part, valuations have been correcting, and for some of the more overvalued segments of the S&P 500 still have plenty of room to continue to correct. That said, we really like to cite the equal weighted index within the S&P 500. It's currently showing a forward PE ratio of just under 15 times. That's now below long-term average valuation, very close to where we see the market fairly valued. Our fair value model leans heavily on interest rates, and if you assume that the market is correct, the 2-year Treasury yield is going to hover around 3% over the course of the next couple of years. That 3% would imply you would be willing to pay roughly 14 to 14.5 times forward earnings for the S&P 500 at large. So we're getting close. Now, valuations, I don't think, are any sort of magic bullet to find bottoms. What I would watch for is some capitulation signals. And unfortunately, on those more technically oriented capitulation signals, we're still not feeling it, we're still not seeing any signs, despite the fact that the market has been so brutal for so many, and we're down nearly 20%. We're just not seeing enough capitulation in breadth nor momentum to suggest we're quite at lows.
Give me that same perspective, Gina, if you don't mind, when it comes to tech, though. Like, have we seen capitulation in growthy tech, and are valuations good enough?
No, is the short answer.
Fair enough. All right.
Growthy tech is where we built up most of the bubble. So when we look at things like, let's take TMT as a big, broad theme. At our peak back in 2020, TMT as a share of the S&P 500 was about 40%. It's down to about 36% of the market cap of the S&P 500, but its income share of the S&P 500 is at 32%. So that would suggest you've got 400 basis points of normalization to go there. Even excluding some of the biggest names in the tech, media, and telecom space, that would be excluding the Microsofts and the Apples and the Facebook or Meta and Alphabets of the world, the tech, media, and telecom sector is still trading above long-term average with below long-term average earnings growth prospects for the next 12 months. So I would suggest that group still has quite a ways to go to normalize valuations, mostly because investors hid in this space for much of the pandemic as it was deemed to be the most stable and secure source of opportunity in the S&P 500, and now has really, investors are really calling into question that theme.
Gina, a lot of folks have been telling us over, coming into the 2020 to focus on quality names, good, high quality names. And, coming into this week, I would have thought Target would be on that list. It's a big company, $100 billion in market cap, 30 analysts follow it, 25 of them telling us to buy it. Yet they missed numbers, took down guidance, and a company of that size and that repute loses 25% of its value in one day. What does that tell you about this market and these investors?
Yeah, well, first I would say you didn't hear from us that you should be focused in quality. We've been very, very big proponents of value as the dominant theme in this kind of market. And I think this is where we really want to distinguish kind of the outlook on inflation as a primary factor that drives stock performance. You want to be in high quality, growthy type names when inflation is contained and inflation is low and interest rates are stable. That's the last place you want to be when inflation is accelerating, interest rates are rising, and margins are falling.
All right, Gina, great stuff. As always appreciate chatting with you, getting your thoughts on these markets. Gina Martin-Adams, Bloomberg Intelligence equity strategist.
Well, coming up on the program, we're going to travel to the world of munis. Yeah, see, it's fun.
It is.
And look at how tax exempts are ignoring larger Treasury movements right now.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
So as rates rise, well, this week, maybe that was a different story, but in general, we've seen a big rise in U.S. interest rates. And as the Fed continues to hike, what does that mean for the actual muni market? Let's get more details now. Bloomberg Intelligence analyst Eric Kazatsky. Eric, as rates rise, as the Fed hikes, what happens to munis?
Typically, they're going to outperform. And it's really hard to look at returns this year and get excited. But munis have been doing what they're supposed to be doing in these environments. I think year to date, we're outperforming corporates by almost 350, 400 basis points. So that's really a success story for people who are comparing sort of cross assets in their portfolio.
So, but that's kind of that's a glass half full interpretation. Glass half empty is corporates are down, total return 13% this year, and munis are down 10%. Yeah. Is that kind of the math?
Yeah, no, that's the math. And look, I mean, just being totally honest and looking at the landscape of all fixed income, right? Everything looks bad. It's just a matter of what your pain tolerance is. And what we're advising clients is just get comfortable with negative returns.
Can you put that into perspective for me? Like negative returns versus, say, the last few years? Like how much of a change is that going to be for investors?
I think anybody who came into municipals for the first time, let's say over the last 3-4 years, this is probably a shock, right? Because they've been sold on this, sort of scenario that it's a sleep at night money, which has not changed, has a low historical default rate, has not changed, but that there's really this insatiable demand. And that's really the thing that's changed, and that's purely a function of where rates have gone, year to date. And that really has been a vacuum sort of sucking money out of not just municipal funds, but, all fixed income bond funds as well.
Where would you go to hide, or what is the least bad sectors that you're looking at here? And maybe conversely, where do you just want to avoid?
Well, the big winners over the last 2 years since the pandemic started really were long duration and lower in credit quality. Those would not be places I would be wanting to hang out right now. Just to give you some perspective, right? Long munis, they're down almost 17% year to date. Compared to the front end of the curve, your losses are just right under 2%, right? So really a huge disparity based on where you are on the yield curve. I think for investors right now, if they're mindful of duration, you want to hang out in that 1 to 5 year period. And as far as credit, munis have shown extreme resiliency through this whole credit and health cycle, right, that we've experienced during the pandemic. And I don't think that's really going to change. I think the areas that I would continue to avoid are the questionable ones, senior housing, those CCRCs, that have lower occupancy issues, as well as, higher ed, some of the lower rated institutions. We think that they could show some weakness as that sort of fundamental model change for how education is delivered going forward.
That's actually quite interesting. Are there any other models that sort of changed that you would have thought was the trend in 2019? I'm also wondering warehouses, that was all the rage, Amazon's buying all of them, and then now that format's struggling a bit.
Yeah, I mean, commercial real estate has always been sort of a strong point as far as ad valorem tax collections for state and local credits. But anytime we head into recessionary cycles, you always have tax appeals as well. So, I'm anticipating that there's going to be some probably, a large spate of appeals over the next couple of years. But those things take a while to sort of work through the system where you actually see that impacting tax collections on the local level.
We actually, on a ratings front, had recently a good story. Illinois, of all states, got some positive news from the rating agencies. What happened there?
They sure did. They've been upgraded the most in the last 3 months than they have compared to the past decade, right? So really an interesting time for that state and that credit. And look, I'm going to give them their due here, right? They have been doing some things to improve their financial picture. Go back 5 years, they had a $16 billion backlog of bills, basically bills that were just sitting there piled on a desk that hadn't been paid, right? They've cut that down to about $2.5 billion now, so certainly an improvement. They've also improved their pension funding. But I don't think that really changes a lot of the issues that they have from a leverage standpoint. That really hasn't changed. So I think that, the rating agencies are taking probably a very short view. And I think that, based on where spreads are in the market for the state, the market's saying that they're not fans of the upgrade.
Let's stay regional for a sec. How's New York City doing?
Yeah. It depends on who you ask. Are you a resident or non-resident?
Oh, I'm a resident.
So, I mean, is New York back? I think that's really the question. And what does a new New York actually look like? I think that New York, along with other major cities, are sort of trying to figure out who they are in an environment where COVID just sort of continues to exist. Whether that means for people coming back into the city from a work standpoint, what that means for local businesses, and ultimately what that means for tax collections. I think the thing that's positive for New York as well as other cities is they still have a lot of stimulus money that they're working through, but that runway is obviously has a timeline that's running out. I think from a credit standpoint, they're doing just fine, and the market is saying so that they agree with that based on where spreads are. But I think there's opportunities in this market too, right? So if you look at New York bonds that are trading right now, I mean, they look exorbitantly cheap compared to how high taxes are in the state, and do present opportunities for in-state buyers.
Really good point. I'll keep that in mind. All right, Eric, thanks a lot. Eric Kazatsky, a Bloomberg Intelligence analyst.
All right, coming up on the program, we look at M&A trends in the convenience store sector.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the past few weeks, the recession fears have really been building alongside the inflation fears. So let's take a closer look when it comes to Europe, because Europe in some ways has it a lot worse. It has a wage growth that isn't as bad as the U.S., but they also have the Ukraine-Russia war and the potential for European gas to be shut off, and that just makes the environment a lot more volatile. So let's get right now to Jeroen Julius. He is a senior credit analyst at Bloomberg Intelligence, specifically looking at the European banks. Give us a sense of how much money these banks are sitting on, how they'd fare in a recession.
So far, European bank fundamentals have actually held up pretty well. The large majority of banks was profitable in the first quarter. Asset quality metrics still fairly healthy, despite some of the risks you just mentioned, Ukraine, inflation, still very liquid in terms of the balance sheet, so no issues there. But what has been happening is that European banks' capital has been coming down, mainly through share buybacks and return of dividends. And that is the big change. Now, this capital reduction is coming from a very high level and also has been very well communicated to the market. We do wonder if regulators are now starting to ask banks to perhaps slow down a little in terms of their capital return plans, given everything that's happening out there, all the risks that are slowly building.
Jen, when you speak to investors, Jeroen, I mean, do you get a sense that it's better to be a creditor to a bank than an equity shareholder here? Because if they're going to cut back on stock repurchases, for example, that's been a big catalyst for, the equity call on banks.
Share prices and bank bond spreads have been pretty bad in performance year to date. For both asset classes, both equity and fixed income. And the hopes were so high coming into this year, given the prospect of higher interest rates, higher steeper yield curves. That the hope was that would boost margins, would boost net interest income, would boost revenue and earnings. And now, of course, that has all sort of gone up in smoke, partly because of the realization that perhaps loan growth, is going to be zero or perhaps even negative, but also the fears about the loan loss charges that I just highlighted. I think there's a growing realization that perhaps that is going to be the major swing factor for European banks in 2022.
What banks have a better shot than others?
Of course, today there's this massive issue in Ukraine that has affected European banks unevenly. There are three names that clearly stood out in all this. Raiffeisen, the relatively small Austrian bank, and then Société Générale, the French bank, and UniCredit, the Italian bank. Those were the three European banks that were the most exposed to Ukraine. Raiffeisen is still very much affected by everything that's going on in Russia. UniCredit, to a lesser extent, they took major charges in their first quarter numbers, and they should not be affected anymore. Those are the three European banks that are the most impacted by, let's say, first-order effects coming from the war in Ukraine. There are also going to be lots of second-order effects, and one of those is the market turmoil. The whole war in Ukraine has increased inflationary risks throughout Europe, and what that means is that for banks with, for instance, large wealth management businesses like the Swiss banks, for instance, Credit Suisse, UBS. They may see their revenue under pressure. The same goes for asset management. That's also suffering. So there are a lot of business lines within the various banks that are going to be negatively affected by everything that's going on.
Yep. And then, of course, like the uncertainty. So even outlooks are going to be clouded as well. All right, Jeroen, thanks a lot. Jeroen Julius, Bloomberg Intelligence analyst.
From European bonds to American convenience stores. Yeah, we can make that switch there.
It tracks.
Absolutely. Diana Rosero Pena, she covers the convenience store business and some retail stuff for Bloomberg Intelligence, and she put out a really interesting report looking at the convenience store business. We're talking 7-Eleven, and if you're from South Jersey, Wawa is the way to go. But there's going to be some M&A in that space, so I thought that was really a fascinating report. I hadn't really thought about that as an industry per se. So, Diana, thanks so much for joining us here. First, just give us a sense of how big is the convenience store business in the United States?
Oh, yeah. So it's actually one of the biggest markets in the world. Is 58% of the global market. Is $123 billion, and it's highly fragmented too.
So if it's fragmented and huge, as Paul said, that means consolidation. What areas are most ripe for that kind of activity?
Well, I think small operators will definitely be the one that will be the right footing for these companies. When I'm talking about M&A, I see it as the big operators looking into smaller ones to be able to get greater sales growth and also expansion into different areas in the United States without actually having to employ a significant amount of capital investment.
So when I think about it, first of all, I love the convenience store. It's got everything you need. You can get the big gulp. You can get some good snacks. Plus, you can fill up the tank and all that kind of good stuff.
And go to the bathroom.
And go to the bathroom when you have to. So, yeah, and that happened. So I think Wawa, I think Quick Trip, and, of course, 7-Eleven. Give us some of the names that are out there that might be on the acquiring side and some of the names that might be thinking about a potential sale.
Yes. So obviously, like I said before, Couche-Tard, 7.
Now, that's a name I don't know. Now, is Couche-Tard 7-Eleven?
Circle K.
Circle K. Okay.
Yes, and then you have 7 & I, which is the owner of 7-Eleven, and you have Casey's, which they operate in the Midwest. So they have been, in the past few years, they have been very active in the M&A space, but it has been on the smaller side. We consider those less than $5 billion. Now, in terms of valuation, we have Wawa valued at about $7 billion at the moment, and then Quick Trip, $6 billion. So, those companies might be within probably, possible targets. I'm not suggesting that they are, but, they have the valuation that is prime for acquisition.
Here's an inflation question for you. There's a huge rise in gasoline prices, and I wonder if that winds up affecting consumer behavior. Does it affect what they do with these convenience stores?
So, convenience store operators haven't mentioned. I mean, obviously, sharp price increases in gas might affect some consumer behavior in terms of going into the store, selecting private label brands rather than the national brands when you get your potato chips and stuff, which actually, if they go that way, they will benefit these operators. In terms of the demand for gas, it seems to be because of the sharp increases they see. It seems to be that there seems to be that urgency of getting your tank filled before the next price increase happens next week. So, operators such as Casey's have commented that they are seeing that. They're definitely seeing that. However, they don't see demand of destruction at the moment. They compare it with the last recession, which was in 2008, and adjusted for inflation, gas prices will have to be about $5.30 a gallon to be able to, for consumers to not fill out their tanks as much.
So if I go look at the economics of an individual store, how much is it like gasoline versus selling stuff in the store?
So most of their operations do still come from gas. I would say like 60-70% of their operations come from gas, and the rest is, in the store. In terms of gross margins, obviously, convenience store operators make the most money when you actually enter into the store. So the gross margins are significantly higher for merchandise than it would be for gas.
I see. So that's why they still make their money with gas, but yet they make better margins when you go in and buy some stuff. Quickly before we let you go, you mentioned the U.S. What are some of the big European players, and are they also on this quest to buy?
So the European market is not as active. Most of the U.S. and Asia Pacific, because that region is probably going to grow the most over the next 5 years compared to the U.S. The U.S. is going to only grow about 7% by 2026, whereas Asia Pacific is probably going to grow about 45%. Wow. So you'll see more concentrated on the U.S. and Asia Pacific than in Europe. In terms of deals that have happened across the pond, you have Couche-Tard, which was interested in buying Carrefour, which is not a convenience store per se, but it's part of their due diligence. They're very they're trying to investigate everything that can give them exposure. So there were the conversations last year that they could acquire Carrefour, but it didn't go anywhere because the government of France decided to stop that deal. So
yeah. They do that.
Yep.
All right. Thanks a lot, Diana. We really appreciate it. Diana Rosero Pena joining us there. Thank you very much.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.